Good morning, all you cool cats and kittens. Of course, I am referencing Tiger King. I couldn't help but laugh at myself this morning, thinking that I might have somehow been channeling Joe Exotic for this webinar. So welcome all you cool cats and kittens. I want to thank each and every one of you for taking time this morning to welcome Platinum Top 50 into your homes. And really for valuing the kinds of content that we are working to put out for you these days. Certainly the topic of building wealth outside of real estate is one that we felt like was super relevant to the times. You know, agents will be the first to admit, they are comfortable investing in real estate because it's what they know. But diversification is the name of the game, right? Whether it's a portfolio, whether it's your services. And so we felt like at a time right now when people are really examining their financial situations, that it would be a good topic to have, right? What are some ways that we can build our wealth outside of real estate, which we know you all are so comfortable with? So we've got an awesome program lined up. As you guys know, Platinum Top 50, our program is underwritten through our valued partnerships, and this webinar this morning is no different. Today, this is being presented by Trendmaker Homes. We are so valued and grateful to be in partner with them. So I would love to take a quick minute and introduce you all personally to Mark Heidman. He is the Director of Sales and Marketing for Trendmaker Homes. Mark, are you there, and can you join me?
Hello, Amber.
Hey, Mark, how are you?
I'm doing well, thank you.
Awesome. Well, I love your background. It's super fitting. So will you tell us what you are up to over at Trendmaker Homes?
You bet. Thanks again, Amber. I just want to welcome everybody that's joining in on behalf of Trendmaker Homes and specifically Six Creeks that we're kind of focusing on right now. And I'd like to thank you for joining us. And I'd also like to thank Amber, you and your team of cool cats and kittens for, for hosting us through the PT50 today. A lot of people have been asking, and so I just wanted to briefly give a quick update on how Trendmaker communities are operating at this time. As many of you may already know, housing construction has been deemed an essential business in the great state of Texas. So because of that, our Trendmaker New Home Galleries are open for business regular hours, 7 days a week, but by appointment only. And that allows us to accommodate folks by appointment, or we can do 100% virtually, as we're doing in our design studio right now for our buyers that have already purchased or are in backlog. So a lot of people say, well, how are you able to do this? And we're doing it by working smarter. We're adhering to the CDC guidelines, making sure that office employees are working from home, and field employees are staying at home, of course, when sick. But also by practicing social distancing in our communities, our models, and during those appointments that we can set. Also, our employees are wearing and supplying face coverings for you, our realtors, but also for your clients in case you guys maybe forgot one for an appointment. So we've got plenty of those on hand. And we're using enhanced professional cleaning procedures and cleaning protocols between our appointments that we have. Appointments have to be scheduled at least a minimum of every 15 minutes apart. That way we have an opportunity to make sure that we're keeping a great, safe environment there. We've also postponed a lot of our large gatherings and meetings and traded it for virtual ones like Amber and her team are putting on for us today. So again, we appreciate that, and we're getting really used to this. And last, we've made, as I mentioned, options for fully virtual appointments, videos, electronic document signing. The whole process can become seamless and easy from the first appointment to close. So the next question that people have been asking me, Amber, is how do I schedule an in-person appointment if I want to actually go out and see the model? And so it's really quick and easy. Either our new home specialist, Jen Hickman, or our new home advisors, like you'll meet Thomas and Matt here shortly, have just 3 simple screening questions. And if the answer to those 3 screening questions is no, we could schedule an appointment immediately if you're already out at our community. If for some reason, or we can schedule it in the future. We can schedule it whatever time works for you. However, if the answer is yes, we simply schedule a virtual appointment via Zoom, like we're using here today with Amber and your team, FaceTime, Skype, and virtually any platform that works best for our realtor partner or for their client. We found that the realtors and the clients both enjoy them and get a lot out of them and can go from contract literally to close in one of these appointments. I say contract to close. We can go and get our contract and then, of course, close at a later date through our title company, which can also do virtual closings, drive-up closings, etc. So in a few moments, we're excited to hear from Tom Valenti of Platinum Wealth Solutions in his presentation. And then after Tom's presentation, Trendmaker's own Matt Dusing and Thomas Sirius are going to share a little bit more detail about the success we're having with you and your clients virtually. 2 of our featured communities, a special promotion for Platinum Top 50 Realtors that are here on this Zoom meeting today. And then last, an opportunity, a pretty amazing opportunity, I think you guys will admit, for your clients on some special financing that Thomas will close with. So just in closing, I want to say thank you all again for joining us here today on behalf of Trendmaker Homes. And thanks for hosting us, Amber, and I'll kick it back over to you.
Awesome, Mark. Well, let me just commend you guys on y'all's ability to, pivot and make adjustments as needed. You would not believe, last week I was in a webinar with Platinum Top 50 agents, and one of them specifically asked about dealings with new homes, in that a builder, not you guys and not one involved with Platinum Top 50, was actually requiring the agent to come out and accompany their client. And this agent is one that has diabetes. And so that was a real big health risk. So I just commend you guys. And I think it's a testament to the quality of partners that we have at Platinum Top 50. All right, Trendmaker, thank you so much for this program. Tom Valenti, will you join me online?
Hey, Amber.
Hey, cool cats and kittens. All right, Tom. So let me tell our audience right now, remind them that at the bottom of their screen is a Q&A function so that you guys can send me questions as we're going through this program, and I'll make sure that I filter them to Tom at the right time or at the end. And then we can also kind of chat through the program too. So you have both of those features for some engagement during this program that I wanted to make sure that you knew about. So let me start. I think it's so poignant as Tom and I were preparing for this conversation, and he made the comment of, gosh, you kind of know what you're talking about. And I do, and I'll tell you why later. And he said, I think it would be poignant if we made mention that we don't work together, right? And I just thought that was such a testament to his professionalism. And you're right, Tom. So I have worked with a wealth advisor, a financial planner for, 12 years now. So I'm excited to have this conversation. But you're right, we don't work together. In fact, it was a lender in San Antonio who works with you that introduced us. And so our working relationship is one that is limited to Tom's a partner at Platinum Top 50 in San Antonio, but him and I don't have a professional, working relationship in the client kind of format. So now that that's put on the table and we cleared the way, Tom, will you please introduce yourself to our audience and tell them about you and your business?
Hi, everybody. This is a little bit different for me, and I'm going to do my best not to bore you today. But I'm Tom Valenti. I'm with Platinum Wealth Solutions in San Antonio. We're a family-owned and operated company. We have offices in 6 different states. I work alongside every day with my dad. Well, not over the last month and a half. My dad, my sister, my brother, and it's a lot of fun. And my focus is just getting to know people, learn about their situation, understand their concerns and their challenges, and then do whatever I can to alleviate some stress and anxiety in their life and provide them some clarity with their money. So I'm grateful for the opportunity that Amber has presented to me today to spend some time with everybody. And thank you for being on here.
Awesome. So I mentioned that, I value this conversation because I cannot overemphasize the importance and role that my wealth advisor, financial planner has played in my life. She's so instrumental in that, I started working with her before I was married. When I didn't even have wealth, but still just the concept of me knowing that there was a professional out there to help me build as I went. So I've been working with her since before I was married, before I had kids even.
So Amber, that's pretty unique and awesome that you did that. You should give yourself a big pat on the back. Most people don't hire a professional until they either have wealth or they've started a family. And of course, then there's various responsibilities that go along with that. So what motivated you to do that at a young age, really?
So interestingly enough, as some of you know, my husband, my then boyfriend at the time, played for 4 years in the NFL, and he was getting out of the NFL and had a little bit of seed money left. We could have a total side conversation of how the NFL plays its players their entire salary in the season. So literally, it's put out into 12 checks. And then a lot of young kids are expected to know how to make that last. So anyways, I had ridden out a few seasons with him, and he was getting out. And in fact, he was going back to school to get his degree at Austin. And it was one of those where I was like, look, you have got to talk to someone, right? And let her give you a game plan. So Allison is her name, and she's been working with both of us individually. And then as we got married, we formulated a game plan. And then as we had children, we formulated a game plan. And then as our wealth started to accumulate, it's something that we continue to adjust. So anyways, that's kind of my personal backstory with how I got involved. So that's why I feel like I'm able to at least have this conversation with you. So Tom, let me ask you the question, right? When we are looking at building long-term wealth, what are some of the tools in the toolbox, right? So real estate's one of the tools, but what are some of the other tools?
I'm going to put up a slide here in just a second. There's a plethora of tools and strategies that people can use to build wealth. I mean, it might not be everything that we're going to talk about, but maybe several, just to have some diversification. One or two typically is not enough. I want to say, Amber, what you just said about the individual you've been working with has been helping you and your husband over the last X amount of years. What's so key about that is that you have coordinated with her in each stage of your life as it has changed and evolved. And that's what's so important, because your financial life has to change and you have to be proactive with updating your financial plan and your strategy. So I think that's really, really awesome. And you have somebody great that you're working with. So I'm going to share my screen here for just a quick second. Can everybody see this?
Yep.
Okay, so just like anything, when everything is balanced, the tires are in alignment, everything is kind of coordinated, is the best. So there's a lot of different things when you talk about how can I build wealth. 401ks that employers offer are a great way. 403b is the exact same thing as a 401k. It's just something offered by a church or a hospital. A nonprofit typically will offer a 403b. And a SEP IRA, which we're going to talk more about later. And there's Social Security, stocks, bonds, various types of annuities. And I'm going to just kind of go back to the regular screen here so we're not just staring at slides. But there's real estate, there's Roth IRAs, there's life insurance, municipal bonds. So there's so many things that we can use. And the strategy you utilize depends on what your current situation is today. And, like, for example, I just want to talk about annuities. There are some annuities you should never touch. They're the worst investments ever. There's some actually that are kind of good, but there's such a negative stigma and connotation with that a lot of folks are very leery of that. And, when it gets into the stock market, we can talk about a little bit, like, what do I invest in? Like, that's a scary place to be. Oil's doing God knows what lately, jumping all over the place. And so, there's a lot of things to be concerned about.
All right. So one of the pivotal kind of tools in the toolbox is life insurance policies. Um, and I'll preface this with that was the first tool that both my husband and I started to use as something that we were using to accumulate our wealth. So he owns a policy on me. I own a policy on him. And Tom, where I'm hoping that you can kind of shine some light. Sometimes when I try to talk with my friends about the life insurance policies that we have in terms of like a wealth accumulation tool, right? One that I think I'm on a 12-year sort of payment plan. I pay the same every month into this plan with the idea that if I don't touch it, right, the compound interest on that policy is going to pay me X amount when I go to retire. And it's not going to be the full retirement, but that will be one way that I supplement my income passively. Okay, so that would be my plan and my policy. And I think we even cast it out to say, well, if I want to retire at 55 and I put this much in for 12 years, starting at age, I think I was 24, 25. Here's what it looks like. Okay, so that's my frame of reference. But sometimes when I go to talk to friends, their perception of life insurance is one where they might pay, I don't know, $1,000, $1,500, $2,000 a year, and it's really just for that 1 year in case tragedy happens. So can you kind of walk us through the differences between different insurance policies?
Yeah, absolutely. It's key to also point out that these various types of policies, a lot of them can be customized for your particular situation. So like what you said earlier, you can have some flexibility to that. So there are three main types of life insurance. Term life insurance is kind of what you talked about. It's pure, really death benefit protection for your family. Extremely low cost, typically for 20 years. Pay a very low cost if you have 20 years of a policy or a contract and you pass away, God forbid, it pays out to the family. If you live beyond 20 years, there's nothing. There's no equity, there's no cash value. And so sometimes that makes sense for folks because there is no right or wrong when it comes to life insurance. It just depends on what is the particular individual situation and what are some of their goals and objectives. But then there are two other types of policies known as whole life and universal life. And I think that those strategies can be really good if you stick to them for the long term for accumulating and building wealth. And so I'm just going to put this up here. We talked about term life, option one, and that does not mean option one or A is the best. I just have to order them in some particular way. But then when you get into universal life and whole life, you can see there's cash value. So that has equity in the policy, permanent coverage. You die in 3 years or you die at age 110, something passes on to family as far as a death benefit. But then there's also cash that is accruing and growing, tax deferred and tax free inside the policy if it's done correctly. So the crediting on the cash value is a little bit different in universal life and whole life, which we can get into more, Amber, if you want to.
Yeah. So let's dive into this because we did just have a question. Russ Phillips, said that this just kind of goes over him, right? The whole life insurance as far as how it's a tool. And okay, so term life is the one that I was mentioning with my friends who, as a precaution, if something were to happen, my family will be covered. And that's kind of the blanket there. Then you get into universal and whole. And with me and my husband, he has universal. So we call it like a UVL, I think, and maybe mine is whole or vice versa. In other words, the money that we're putting in, one of ours is in the market to get its gain, and the other one is at a more conservative approach, okay? And so the idea, and this is what really sold us on this tool as a way to build wealth, was that as much as we put into this policy, and Tom, correct me if I'm wrong, okay? As much as we put into this policy, if at any time we needed to access the cash that we had put in, there was liquidity to that. And so that's what gave us a lot of comfort in saying, okay, well, If we put it in and if we don't touch it, it's going to compound interest, right? And that's going to help us get to our retirement goals. That all sounds good. And then if in addition, you're telling me that in the event I needed to access that cash, I could, okay, that made sense to us. And then there's the added benefit to the idea that it is also a legacy tool that God forbid something happen, our partner would be taken care of. Does that kind of hit the mark for the two whole lives that you were referring to?
Really, really good. I'm impressed again, Amber.
Hey, when I say like, I was excited for this conversation because I have invested a lot of my time and energy in learning about this, right? And it's where, you know, again, when I say I try to have conversations with my friends who are in their mid 30s like I am, and they're just getting started with this, we're sometimes talking about apples and oranges, especially when it comes to life insurance, because I'm 7-8 years into understanding how this tool can work for me. So can you kind of walk us through the differences between the two whole life and universal?
Right. And I'll just say, me personally, I have all three types of life insurance because I think they all do play a role. Whole life is the most expensive, and it's the most expensive because your cash value that you can withdraw, like you said, Amber, is and there, it's always has some liquidity to it. If you touch it in the first 5-6 years, it's only partial liquidity, but at least there's some access to that money. The best is if you can wait 10-15+ years to actually pull the money out. So I didn't want to make that point clear, but nice to kind of have that backup of like, oh my gosh, what happens if I need some money? Can I get to it? Absolutely. So on a whole life, most expensive, but you're paying for guaranteed dividends. So the company that you have the insurance with says, we're going to guarantee you a minimum dividend of 4.5%, but we might pay up to 6, 7, or 8% if the company has a really good year. And we'll credit your cash value at that particular interest rate. And that's what's compounding over time. So you're paying to have predictability. That's fine. I mean, we know what we're getting into. And like a lot of people love that. Like, I'll pay for whatever it takes to know I'm going to get X every single year. The universal life is going to get credited not on a guaranteed dividend, which is why it's a little bit less expensive, but based on interest rates, which really are nothing right now. So most people are going towards the market and having variables. So your cash value is going up and down with the stock market. So in the last few months, you actually would have lost some money in the cash value, but it's going to operate like a 401k as far as the cash value growing, which long-term generally works out pretty well for folks and can average somewhere around 8% or so. If you just look at like Dow Jones Industrial Average or S&P 500 market returns, 8.5% over every 10 years is pretty realistic.
And there's added benefit in that it's a death benefit too, right? So like there's added value Correct. In terms of the security that it gives. And yes,
so it kills a couple, lack of a better term, it kills, a bird, two birds with one stone.
Right.
So
right.
great benefits with it.
Well, and also just to share with the audience too, personally, while we have been using this as a wealth accumulation saving tool really for retirement, it's not one that we go and access to like put a down payment on a house, right? Like while it's there, that's not how it's being used in our household, at least. It's one that we really would be a worst case scenario that we'd have to go to that. But by and large, it was set up to fund us in retirement. And I just remember, seeing the numbers for compounding interest. And agents, since you guys are familiar with numbers and interest rates, this is no surprise to you. But I remember being young, seeing the numbers going, okay, wait, if I put in this amount over the next 10, 12 years, by the time I'm this age, it's going to pay me this amount a month just on the dividend. And then I can still go and access that when, and I think I'm remembering now as I'm going through this, our strategy was that, the dividend would pay us. And so that would keep a steady income stream coming. But also we would go to access the like lump sums as we got older when we moved into lower tax brackets, right? So it's like you didn't want to be accessing that when you're in your highest earning years. It's more appropriate to access when you're older. Is that fair to say?
It's fair to say, if done correctly, the cash value access should always be tax-free. So it should not impact your tax bracket. But ideally, the point is I go to retire and I don't have very much taxable income.
Okay, perfect. We've got a couple questions coming in that I'd love to get to. So Mary Rodriguez, hi Mary, asks, please talk about the age factor. Which type of insurance may be a better option for a certain age?
Great question, Mary. It really, really depends on health. You know, insurance companies will insure all the way up to about age 90. Some depend. You know, of course, the older you are, the more expensive it is. I would say as a general rule of thumb, anybody over 55 should probably purchase universal life versus whole life. But that's, I mean, again, it just depends on the situation and health. And then folks that are 20s, 30s, 40s should have likely a term policy. Again, it's client specific, but likely a term policy and a whole life or universal life, and supplement those two together for the benefits that they offer. So it's hard to, I'm sorry if I'm not answering that correctly. It's hard to answer that without knowing the particulars.
Well, the thing is, Tom, is that agents can understand that because they would be giving that same advice to their clients, right? Like every home buyer and seller is a different situation.
Mm-hmm.
So it just depends on their circumstances, on what kind of advice they would give them, when to buy, when to sell, that kind of a stuff. So they can certainly appreciate the context of that. Okay, so we're having a question come in about insurance policies for your children. Mm-hmm. Which is something that you and I have talked through already, because you know, that's something my husband and I are using as a wealth accumulation. So let's, Alexia, we're going to get to that question. Let's jump over to college. Well, we don't have to. Let me see.
Amber,
here.
do you want me to show those examples?
Yeah. Let's do that, and then
okay.
Let's talk about Alexia's question, and then we'll hear from Trendmaker, and then we'll go to college. Okay, perfect.
Sounds great. Okay, so I'm putting this up just so you can kind of see the drastic difference between a term policy and a universal life or a whole life. This is an example of a 40-year-old female, average health, $1 million policy for 20 years. I mean, it's less than $500 per year, or $40, $42 a month. And those are some companies up there listed that would offer that type of coverage. So very, very inexpensive. Actually, term policies only pay out about 2% of a death claim, because most people do not pass away in the 20 years or the 30 years that they have that term. So actually, term is a very profitable business for insurance companies. And then this is a little bit smaller here. But this is an example of $1 million policy, but it's universal life. So it's permanent. It's about $15,000 a year. You can see that plan premium, third column from the left, $15,000 a year for 25 years. You could do it for 10 years or 15 years, but I'm just showing you an example. And then if you go to the middle, it says policy value. It's about $750,000. That's the cash value. That's a tax-free asset that you can do whatever you want with down the road. Take it out for a second home, to help pay for a grandchild's college education, to do whatever you want. Take a stream of income to supplement your retirement income. And then on the far right, that $1 million policy is now a permanent $1.6 million death benefit, because there's so much cash in it. So you have a huge, large death benefit that is never going to expire, and almost $750,000 in a tax-free asset. But again, it costs a lot more. These are great if you stick with them. If you play by the rules, just like a lot of things in life, and you stick with the plan, this can be a massive wealth accumulator and a fantastic benefit. If you don't play by the rules, you can get in some trouble. I really like the concept, and I think a lot of the folks on this call will appreciate, wow, those numbers look pretty good. So maybe a piece of the overall pie of the financial plan.
Awesome. Okay, perfect. So this kind of takes us roughly about halfway. And just to let our, audience know, right? Like Tom and I thought it would make sense to start with life insurance. Then we're going to go into college savings and different opportunities. And Alexia, that's where an option of having a life insurance policy on your children becomes an option for that college. So we'll cover that then. And then we're also going to talk about the different retirement accounts that, self-employed folks like ourselves can take advantage of and invest in. So that's kind of a look at what's to come. Trendmaker, Matt, Thomas, can you join me real quick? So Matt has had a 100% virtual transaction with an out-of-state buyer. And so I'm wondering, Matt, if you can talk us through that for a quick minute.
Sure. Thanks, Amber. And by the way, this is a great conversation. I'm really enjoying this content. But thank you guys for your time and letting me speak briefly with you. As Mark said earlier, all of our communities are currently taking appointments in person and virtually. We've had quite a bit of success with virtual appointments, and 2 of my sales in the last 30 days were made through video conference meetings. The first one was a great experience with a real estate agent who came in, an out-of-state buyer. We worked together. We were able to send over photos, videos, then had a virtual meeting. We'll walk through the home, and they ended up purchasing the home 2 days later. Since then, our company's set up training with us on selling virtually so we can create a better virtual experience for you and your clients. So we're all set and ready to do that. We've been, again, training on it to get better at it, to make the experience better, more efficient, and give us a better chance of helping your clients get the home they need. Thomas has also had tremendous success in the current environment, so I'm going to kick it over to him to let him tell you more about his community, Six Creeks.
Hey, good morning, everybody. Thank you, Amber, and thank you, the PT50 group. I thought I would share with you straight away that I'm a pretty humble guy, but I won a follow-up contest recently on Salesforce, and just to show you what the times are that we're involved in, the grand prize was 2, not 1, but 2 24 packs of toilet paper. So I live out in Dripping, and toilet paper is super hard to come by, and my daughters refuse to use paper towels, so go figure. Anyway, so thank you. I'm coming to you guys from West Kyle. I'm in Six Creeks. A number of you have been out here already, and I appreciate that, but so many more of you we would like to see. So Six Creeks is being developed by an Austin developer. So once you pull in here, it's going to have an Austin master plan feel. The aesthetic is going to look as such. This is the first true master plan move up in Kyle, move up neighborhood that is. We're offering new plans, and that's what you guys have come to expect from us, brand new home designs. And it's been quite the rage recently. I mean, the sales are really popping off quite a bit here. Price points like high 200, mid 300s. And I've got 2 things for you here. So any of you agents watching now, Zoom, you can come on out, and if you sell an inventory home, we give you an extra $1,000, and that's for Six Creeks only. And then citywide, we're running a promotion now, and believe it or not, this is going to blow you away. It's a 2-1 buy down. So year 1 is 1 1/4, year 2 is 2 1/4, and year 3 until the 30-year loan is going to be 3 1/4. So that certainly piggybacks on Amber and Tom's discussion about building wealth. And most certainly, I think everybody would agree that Kyle is the next, boomtown suburb of Austin. So coupled with this financing, I think it's a real big win. So with that said, I hope to see you guys out here soon. Like Mark had said, reach out to our website rep, which is Jen Hickman, and we'll set you up for an appointment here and practice all the proper protocol and make your clients feel super safe. And I appreciate you, and back to Amber.
Awesome. Thomas, wow, I've seen a lot of different builder incentives program, but one never about financing like this. So what a cool value add and way that you guys are adapting and helping agents and clients throughout this time. So super awesome. All right, Tom, join me back here now. And let's talk about college savings. I feel like that's probably the next piece to the puzzle, at least in my experience it was. So
Absolutely.
can you walk us through what some of the options are for college saving plans?
Yes, there are three main types of plans to save for college for your child or grandchild. And there are Section 529 savings plan, 529, 529 plan. That's the most common plan that people use. And what's great about that is it grows tax deferred, and then it's tax free if used for college. So you don't ever have to pay taxes, which a lot of people like, similar to the concept of a Roth IRA, which we're going to talk about here shortly. The other option will be just a regular old mutual fund or brokerage stock account. There's no tax advantages whatsoever to that, but it provides you the most flexibility because it does not have to be used for college. It can be used for anything. And then the third option would be a life insurance policy and taking money out of the cash value for that particular child when they do go to school. But the life insurance at the bottom provides withdrawals for college, maybe that you want to buy them a car, help them on their first home, help them start a business. And so you can take that out of either your stock brokerage mutual fund account or your life insurance policy. And so that's why I like the flexibility. When the new tax law came into effect here a couple of years ago on 529 plans, you actually can use a 529 college savings plan now for a private school K through 12. That's most states. So kind of unique, and that's great because it provides people with more flexibility, should they need funds, because private school is very, very expensive. I want to, touch on the life insurance for a child. If you lock in their insurability, so you do that with a universal life or a whole life. Typically, it can be done with a term, but you typically want to go the other route. And you want to do it while the child is as young as possible to give that compounding interest effect to really do its best over time. If the child is over the age of 10, using life insurance to fund their college probably is not the most optimal route. It could be a piece of the pie still, but not the best. I saw a comment come through. I got a comment on because I took it. He said astronomy class at UT was easier, I think, than figuring out life insurance. And I can relate to that because I also did at UT and it was really difficult. So I would tell you, I'm here, of course, to be a resource. Amber's an expert, obviously, and then anybody and any other insurance professional or financial planning professional that you know can walk you through these scenarios and educate you on what's the right thing for you.
Yeah, and okay, so the idea of policies on your children, like at first, I was like, huh? Yeah, our insurance lady, who again, we love, we trust her, like go to her if they need big monumental life. So we came to her with the first baby, we got insurance on him. And to your point, I think it was 6 months, right? Was the soonest that we could. And we were doing it to create, as we call buckets for each of our kids. Whether that was for college, maybe it was going to be a trip to Europe when they graduated from high school, like that. We would just wanted to create a bucket for our kids. But we also knew that, again, there was liquidity in that policy if we needed it. And so that gave us comfort. And, I will say too, so while we set up for the first kid, okay, great. Then came the second kid. We're like, oh gosh, well, if we did it for the first, I guess we got to do it for the second. By the time the third one came around, we were like, holy cow, what have we gotten ourselves into? But we went ahead and set that up for her too. And like my financial advisor says, you don't have to tell your kids, you have this. You can set it aside for a car. You can set it aside for college if they get a scholarship, right? There's some flexibility. But I will say that the added two benefits for us in deciding to go that route as our college saving plan was the fact that if one of our children were to get sick, okay, God forbid, something happens when they're 10, 12, you name it, that you can actually access, I forget what it is, it might be half the policy, Tom, you can correct me, but we could actually access some of that death benefit to care for them during that time. And I just got goosebumps because, again, that's something that when you look at the different options, for us, just gave us the flexibility and level of comfort. And also it's a legacy gift is how we were, envisioning this too, a legacy gift for our grandchildren, essentially, right? Starting that when our kids were less than 1 year old. So wealth accumulation over time. I think that's kind of, the name of the game when it comes to, using that tool for children.
That's all great, Amber. And you just also never know if a child could get sick before, while they're still a minor, and they still might live a really long life, but the insurance company will not accept them because that's a pre-existing condition. Life insurance is different than health insurance. And so we had some folks that took out $250,000 policies on each child at like 3 years old. Well, one of them at 12 got very, very sick, now doing great. But now she has that. And of course, there's cash that she can access. But when she starts a family, she already has life insurance because her parents made such a wise decision at a young age to do that for her. So a lot of different benefits to it. Some people said it's morbid. I don't want to buy that and attract that. And something happened to my kid. I mean, anybody that wants that is crazy. It's something that you do just as a planning precaution, and likely will never be used while they're a minor. But it's a gift to them, really, is what it is. I guess, how much do you love your kids, and how much do you want to give to them?
When I say legacy tool, that's what I mean, right? Like, we were viewing this as a legacy tool. My husband and I don't come from, there's not wealth to be handed down from generations to us. Mm-hmm. And we were realizing that that's something that we would love to be able to pass on. So let me ask this question on the topic of college. Alexia, great question. What is your opinion on the Texas Tomorrow Fund for saving for tuition?
Not as good as it used to be. I think you're more restricted in what you can use that for, and that's only for tuition credits. I would go another route and use a 529 plan, because you can get a 529 plan in any state, Virginia, Texas, Utah plan, and you can apply it to any institution in the country, or a culinary school, or a vocational school, or whatever. So I think you want to purchase something that provides you flexibility. So I would not do the Texas Tomorrow Fund. It's not a poor choice, but I think there are better options out there.
So let me ask this. What if you go into, the 529, and then, your child decides school isn't for them. I want to cut my teeth and be an entrepreneur. I'm going to go start my business, right? Not a bad situation, or even an unlikely situation, given that most of us on this call are entrepreneurs, and hopefully our kids pick up on that, right? So what does someone do in that case?
The money is still yours. It's always in your name. But if you take it out for something that's not for college, it will be taxed at a 10% penalty. And it will be taxed at regular income rate. So instead of tax-free, so you're going to pay regular income taxes on whatever the growth is. And then you also pay a 10% penalty, like an early retirement distribution. So it's still yours. It's just the government, IRS, take a bigger haircut of that money. Now, if the child gets a scholarship for whatever reason, kind of just different than what you're talking about and being an entrepreneur, if a scholarship's $20,000 a year, you can take out $20,000 a year from that policy and use it for whatever without penalty. So so the government does not penalize for being a child for being academically, smart or athletic.
So let me ask this then.
And you can transfer it to other children.
That's what I was going to get at, right? Because I think I've been, told that, well, if we wanted to invest in one of those policies, in addition to the buckets we've already put for our kids, that if we started it with our oldest kid, for example, we could pass it to the second, we could pass it to the third if we needed. So you just validated that. That's correct, right?
Yes, that's correct. And a 529 is just a mutual fund account. That's all it is.
Okay. On the question of life insurance death benefits, Russ is asking, does it get distributed to your beneficiaries tax-free?
Yes.
It does. Okay. And does that differ depending on the type of life insurance you have?
All life insurance is tax-free. There are some very, very, very rare circumstances where it would be taxable. That's 0.01% of the time.
Okay. Right. Which that's the whole thing. It's like, it shelters it for you, right? Mm-hmm. Like, the tax benefit is one of the biggest benefits that come from knowing about these kinds of tools, which I just think most people just don't know them, know mm-hmm. that they're out there. All right, so let's go into retirement accounts, specifically, IRAs, and then we've got some time left over for Q&A. So this is timing out to be great.
Okay.
So retirement accounts, right? 401ks, we all know typically for those employed, but those of us on the call are self-employed. So talk to us about some of those options.
There are two main types of retirement plans and accounts that I would put money into if I were self-employed, which I am self-employed like most people on this Zoom meeting today. A SEP IRA, a SEP IRA is a self-employed IRA. That's something that a lot of agents should explore as an option with their business. Depending on how their business is structured, if they have some W-2 people that help them, assistants, etc., transaction coordinators, then you have to put money in for them if you have a SEP. So there's some nuances to it, but depending on your income threshold, you might be able to put $50,000 into a SEP IRA pre-tax and take it right off the top for your taxable situation, which can be a massive help when it comes to time to pay Uncle Sam.
So let me stop you, because here's where this is the newest now product that we've added to our portfolio. And in fact, I've only done this once before. So with the SEP, so husband has 401k, okay, with the SEP, correct me if I'm wrong, but don't I have flexibility to pay up to 20% of my salary? Like 1 year I could do 5% contribution, 1 year I could do 10%, 12%. I, as the business owner, get to dictate what
Correct.
percentage of my salary goes into the SEP. However, that same percentage goes to every other employee that I have that qualifies. So if I put 20% in 1 year, I have to go legally and put that 20% for my employees based on their salary, correct?
That's right. If they're W-2, if you 1099 them, it does not apply.
And also, there's something too where we put into, maybe it was through our employment agreements, which my wealth advisor also helped me craft, that like our employees become vested in that after 3 years.
Mm-hmm.
So for the first, so in other words, it's not that anyone who comes on or comes off as an employee necessarily qualifies for that. Is that correct?
That's right. Typically you do a 3-year. So you don't have to immediately put money in for employees. It can buy you some time to, I call it's being selfish as a business owner. I'm putting away for me. And then if they're here in 3 years still, and they've been loyal to me, now I will benefit and I'll reward them and I'll put money in for them. So that's correct.
Yeah. And it's based on salary, not on like bonuses and so forth. So again, having a financial advisor, someone who can walk you through employment structures and so forth, could be really advantageous. At least, I have found that experience, especially when you're talking about SEPs. So you went through SEPs, and then what's the deal with Roth? I feel like that's the other term that gets thrown around a lot.
A Roth IRA is a retirement vehicle that folks use that is all tax-free down the road. And I'm going to put up a slide here in just a second. And you, in theory, can have both. So I'll pop the slide up in just a second. Okay, here we go. So again, SEP IRA only for the self-employed. Talk a little bit about it. Tax deduction now, fully taxed in retirement after the age of 59 and a half. Okay, so that's key. The Roth IRA, no tax deduction right now, but all tax-free down the road. But you can only do $6,000 or $7,000 a year into that, which some people say, well, that's fine, that's great. I'll do that, and then if there's extra money left over, I'll fund different types of investment strategies, which anyone competent can help you with that. Both of those can be invested in the exact same thing. A SEP IRA and a Roth IRA are not investments. They are the wrapping and the strategy that you can put investments into. And so that's a key distinction. Mutual funds, stocks, bonds, whatever you want to buy. Potentially even real estate, that kind of is a mess. I don't really recommend using your IRA to purchase real estate, but in some cases, some companies will offer you the ability to do that. Anyone who has earned income, you can do a Roth IRA. If you do not have earned income and you are single, you cannot do it.
So let
you
me
gotta
ask, with the Roth, if I were to put in, max that out at 6,000 a year, does that also apply for employees in terms of like, now you match that lump sum, or is it a calculation based on salary, like the set?
a Roth IRA is only you. Only you as an
Okay.
individual, not a true retirement plan that would have to be offered to employees.
Okay. And correct me if I'm wrong, because I likely am, but the SEP, in that it's a percentage of your salary, and you just showed it maxes at what, 50,000?
Right.
So,
So 250,000 of income potentially.
okay,
20% would be 50 grand roughly.
got it. Okay,
And
that
that would
was
be
that.
that would be your maximum. Now, if you're set up as an LLC, taxed as an S corporation, which a lot of higher producing real estate agents are, and if you're not, then you maybe should explore it with your tax advisor or your CPA. Then it might not be 50,000, it might be 20 or 25,000, but that's still great because that's a big benefit. And not to mention putting money aside for a rainy day down the road so that you don't always have to work in real estate as hard as you are. I mean,
Yeah.
I think most real estate agents will say, as long as I'm healthy, I'll work as long as I want to. But wouldn't it be nice not to have to work as hard?
Okay, so question. What was said about being single with a Roth IRA?
Single with a Roth IRA and you're not working, which is not common, but it happens, you cannot fund a Roth IRA because there's no earned income. If you're married and one spouse works, you're fine, because even if you don't have income, you can call it a spousal Roth IRA. So you're covered there.
Okay, so same kind of going along the same lines. If I gift money to my children, ages 19 and 16, can they put it in a Roth?
Yes, very, very wise choice.
Okay, okay, awesome. All right, let's open it up for Q&A. I'm looking here, and we've got a lot of great ones that have come in. So let me start by asking one from Matt Friederlin. Great conversation. I am all in for wealth accumulation, but as we know, there is risk for us as realtors. I would love to hear Tom's thoughts on umbrella insurance for wealth protection.
I just bought an umbrella policy myself last year. I think it's
What is an umbrella policy?
An umbrella policy protects you if, like, the dog bites somebody falls in the pool. That's an insurance agent question that can talk you through the specifics. But you don't want to have something silly happen, or there's a car accident. Now everyone's suing everybody. What if your auto limits are not high enough? Then they can come after you for more money in your personal assets. So the umbrella policy can protect your personal wealth. I mean, you can get $1 million, $2 million umbrella policy for $100 a year, $200 a year, maybe on the high end. So absolutely, cost benefit is worth it. I think it's a no-brainer.
Okay, awesome. Let's see. We covered age factor. Let's see. Someone says, I paid into a policy I started through my credit union since 1998. It hasn't ever renewed. I'm now 45. What should I do to elevate to see if it's the right policy for me? Oh, evaluate. I'm sorry. What should I do to evaluate if that's the right policy for me? So started back in 1998, never renewed, now 45.
Two things. You need to get a policy summary page from the insurance company, so whoever it's through. And then you also need to get an in-force illustration or an in-force ledger that provides you all the details. And then someone like me or somebody else can help to analyze that to figure out if it's still good and you should keep it, or transition and change it to something else.
Okay, awesome. Let's see. Any last questions?
There's a lot of fantastic questions on here, Amber, that we're not going to be able to get to, unfortunately.
Well, if you see one, grab it out. We've got 6 more minutes.
There's a question about income threshold and Roth IRAs. You're phased out at a certain point. For example, a couple and their adjusted gross income is $200,000 or higher. They cannot directly fund a Roth IRA because it's too good of a deal. They make too much money in the IRS's eyes. However, you can still do it. You just fund a traditional IRA. 3 days later, do a Roth IRA conversion. There's nothing wrong with that. Just a couple more steps for the individual. So the strategy still works. So you can do that. Also, solo 401ks can be used for self-employed professionals. I would go a SEP IRA route versus a solo 401k if you're self-employed, just because you're going to pay administrative costs because it's actually a 401k with anywhere from $400 to $1,000 a year. That's just wasted money. But everything, of course, is client specific. So a solo 401k may make sense. Typically, that's not the first one we look at, though.
Tom, if someone wanted to gift their children money through a Roth, is there a certain amount of income that's needed for that?
For the child?
I'm guessing that's what it is, yeah.
If they have any type of, there are some ways around that. Typically, the child's supposed to have some type of job, doing something, making a little bit of money. But I have seen some folks do that with children that are not working. I guess you're only going to get caught if you get audited. Again,
So
I
Tom's
like to do
disclaimer
everything
is
as straight and narrow as possible.
Yes,
Yeah.
you'll put them on the payroll, right?
There are ways to do it. Pay your kids.
Yeah,
You know.
yep.
Yeah.
Especially at ages, 16 and 19, who certainly can
Correct.
help if they're not already. All right, last question here. If you, a realtor, okay, are set up as an S Corp, then you get a tax deduction on your S Corp for a 401k. Your company can make a contribution, and you also, as an employee, can make a contribution up to 20% of that salary, right? So you can contribute a lot in 1 year, right? Is that statement is correct?
You 20, yes, that's correct.
As an S Corp, you can contribute up to 20% of your salary.
Yes.
Perfect.
Your salaries, 100,000, 20,000 could be put in. Yes.
Yep. Okay. Awesome. So Tom, this was so great. And look, we're going to talk financial planning. Isn't always
Fun stuff.
the most fun, but I think it's fun, and you think it's fun, and we think it's fun because we understand it. You know what I mean? And so, I feel empowered to have this conversation because I have invested in learning this a little bit over the last 10 years. And so I love so much the questions. You guys, we will send you Tom's slides. We'll send you his contact information also in the follow-up email. And several of you have been asking for the flyer that Trendmaker shared on the financing program. So we will be sure to include that in the follow-up email as well. You guys have been so great. Y'all have stayed on with us from start to end, which is a lot to ask when you're talking about financial planning, but it's super relevant. And I'll end it by saying thank you. Thank you so much to Trendmaker Homes for being the ones to bring this program to you this morning. Tom, thank you so much for your time and willingness to join us and share your insights and wisdom. And to our audience, y'all, mark your calendars. Next week, we are bringing Thinkers and Doers to you live. So it will be an event that we hope to have 300 or 400 people join us for. Typically, we sell tickets to this event. Not this time. We're bringing it to you free. And we are going to have City of Austin talking to us about affordable housing. We are going to have some exciting information from the new development, the St. Elmo Public Market. So something really cool and positive that you can start to talk to your community and clients about. And then also Capital Metro on the $60 million of funding that they have going on through Project Connect. So you guys, thank you so much. Keep in touch with us. We will continue to bring you the programming that you want. So let us know what conversations you want to be having. And a special thanks to everyone. So thank you guys so much for the positive comments and for joining us. And we hope to see you again Friday. We have one. And then next week for Thinkers and Doers. So y'all take care. Bye. Thank you.